All right, turning our attention now to energy, the only sector that's actually up today. Oil prices are back above $90 a barrel. It's up more than 16% this week, and that puts it on pace for its best week since March. Joe, I'm going to turn over to you. I mean, you're our energy guy. When you look at the oil prices right now, of course, a catalyst was those OPEC cuts. Natural gas demand also rising. What's your outlook on energy right now?
I still think you need to maintain an overweight to the sector. That's rooted just in the extreme supply to demand imbalance that currently exists and can over the coming months be threatened even further. You've seen so far month to date, energy equities up nearly 15%. I don't think that whether you're a trader or an investor, you need to accept a higher degree of beta in the energy space. I think you're going to be fine allocating towards an ExxonMobil, a ConocoPhillips, an EOG, a Phillips 66, or my favorite name, which was PXD, Pioneer Natural. They're all outperforming so far month to date. So I think it's right now it's almost an easy layup, and that's where the momentum is in the market. And there's all the reason to stay committed to an overweight position. All
right, a lot of energy and oil ownership here on the desk. Jim, I'm going to come over to you. I saw you're looking over at Joe when he was talking there. Do you have some thoughts in mind?
I'm in complete agreement. Just from a fundamental point of view, supply and demand is out of balance, and it's going to stay out of balance for quite some time. And in the immediate future, you have the prospects of the EU's sanctions and withdrawing from buying any Russian oil, or at least trying to cap the price at which it's bought. You've got China potentially coming out of its COVID shutdowns. And you've got, at some point, the releases from the Strategic Petroleum Reserve are going to come to a stop. All of that's going to exacerbate an underlying supply-demand imbalance. So I agree with Joe. You're supposed to be overweight energy here.
Yeah, you know what? Joe's calling energy a layup, but one thing I want to talk to you about, Jenny, is one of your holdings, Shell, out with a warning just yesterday about profits, about margins. I mean, why Shell when everyone else seems to be on the right path?
Well, I think Shell has different European exposure than everyone else. But they're still going to make a ton of money. And I think when you look at energy broadly, here's where I am, which is you definitely want to be overweight. We have about 16% in our equity income strategy in energy, and that's served us well. But it's also grown. But here's what I'm looking at right now. Right now, I'm looking at the next 12 months of earnings growth for all the S&P 500 sectors and the forward PE. Energy still has the lowest PE of any of the sectors in the S&P 500, and it has positive, it says right now, about 6.5% forward earnings growth expected. That's a pretty unique combination for this kind of market. So I think you want to hold out. Shell specifically, we still own it. We think that they're fine for the long run. We'll make a ton of money, but we also feel that way about the rest of our holdings. We also own Pioneer, Devon, Chevron, and then we own a bunch of the pipeline companies like Kinder and Williams. And I think if you want to be more conservative, you can own the pipeline companies. If you want to have more exposure to the actual price of energy, you can own the majors. So
yeah, important to know as we hit session lows, the XLE energy ETF up over 0.5% right now.